As we already know, the logic of the market is very simple. It is based on three main elements: liquidity, volume, and inefficiency. Any movement can be described using just these three concepts. At the top of this chain is liquidity, which is the sole driver of the market. Without liquidity, that is, without buy or sell orders, the market simply would not move. It is important to understand that any element on the chart can provide liquidity, but the question is in the quantity. The second most important element, and the foundation of all our market logic and strategy, is volume, which directly reflects the amount of liquidity entering the market. In other words, how much money has entered the market. And the third element is inefficiencies, which are formed as a result of the influence of volume on price. They are graphical representations of volume at a specific moment in time, depending on the time frame. Inefficiencies will be the tools through which we will look at the chart and do our analysis. To understand the deep logic of inefficiencies and market movements, we need to consider two main factors. The first factor is the state of the market at a certain point in time. It can be of two types: balanced or unbalanced. What does this mean? When the market is in a balanced state, the volume of buys and the volume of sells are equivalent to each other, and the price hardly moves. In other words, neither buyers nor sellers dominate the market. This is very rare and mostly happens on days with very low volatility. The second type is the unbalanced state, which is more typical for any market. This occurs when the buy volume is greater than the sell volume, and the price rises, or when the sell volume is greater than the buy volume, and the price falls. We have sorted this out. The second factor is the efficiency of price delivery, which also comes in two types. The first type is called efficient delivery because in the context of a certain market movement, there are both buyers and sellers present, allowing for a more even exchange of assets. It is important to consider that price delivery is always an unbalanced process in which one side, either buyers or sellers, dominates. The second type is inefficient price delivery, which implies that the exchange of assets occurs unevenly in certain price ranges between buyers and sellers. This means that there are places in the market where orders remain unexecuted or only partially filled, which is a key sign of inefficient pricing. The fair value gap is a price action element, formed by three candles where the high of the first candle does not cover the low of the third candle in a bullish scenario, and the low of the first candle does not cover the high of the third candle in a bearish scenario. The logic behind this tool implies an impulsive price reaction to zones of liquidity or inefficiency due to a surge of a large amount of liquidity into the market, which we also refer to as volume for buying or selling. This leads to an uneven exchange of assets between the parties. When a bullish fair value gap forms on the chart, the range where the wicks of the candles do not overlap indicates a lack of participants who were ready to sell as much as buyers were ready to buy. In other words, there was not enough selling volume to absorb the buying volume, resulting in unfilled buy orders. Conversely, when a bearish fair value gap forms on the chart, it means there was not enough buying volume to absorb the selling volume in that range, leading to unfilled sell orders. This is the main reason why, when these zones are tested, the price often reacts and reverses in the opposite direction. When the highs and lows of the candles overlap, we cannot assert that a fair value gap has formed, meaning the exchange of assets between buyers and sellers was much more efficient. Hence the name fair value. Now let's talk about FVG levels and the price reaction from them. Basically, we have the upper and lower boundaries of the fair value gap, but the 0.5 level is often marked as well, which is considered quite strong, and ideally, the price should bounce off it. Therefore, it can also be used as an entry point for a position. As for the validity of the FVG when it is tested, it is quite complex because much depends on timing. However, in my opinion, the main thing is that the price does not close below the lower boundary when the FVG is bullish, and does not close above the upper boundary when the FVG is bearish. This would be considered an inverted fair value gap, which may indicate a continuation of the movement. Everything else is permissible, but again, much depends on the context. Let's look at a couple of examples on a real chart and then move on to the next tool. A fairly simple example of a fair value gap is as follows. The price performs a liquidity raid, after which very aggressive buying volume enters the market, forming two FVG zones. The price tests the first zone, but does not receive enough volume to continue moving further. Then the second, lower zone is tested, from which a rejection block is formed, and the price continues to move in the direction of the trend. In the given context, on a one-day time frame, two fair value gap zones have formed. We can clearly see that each zone, after being tested on the chart, forms a new one, and the price never closes above these zones. This means that the fair value gap has enough strength to cause the price to reverse and move in the opposite direction. An order block is a price action element representing a price range where the highest volume was traded, often formed manipulatively. Forget the assertion that an order block is the last candle before a reversal. This has no logical basis. First, let's note the two types of levels that form in the market for a full understanding of this tool: support and resistance. A resistance level is formed when there are two candles, the first being a buy candle and the second a sell candle. Where the first candle closes and the second candle opens is our resistance level. A support level, in turn, is a formation where the first candle is a sell candle and the second is a buy candle. Where the first candle closes and the second opens is our support level. Based on basic logic, these levels represent points where the balance between buyers and sellers shifted. This gives us reason to believe that large players opened or closed their positions there. Therefore, there is a chance that when these levels are tested, additional buy or sell volume may enter the market, with large players buying or selling in these spots again. It is believed that in this way, they can protect their previously opened positions. How is the order block zone formed? The order block zone implies a breakout of the resistance level, buy plus sell candles, and a close above it for a bullish order block, and a breakout of the support zone, sell plus buy candles, and a close below it for a bearish order block. Let's imagine we have a zone of liquidity or inefficiency. For the price to reach this zone, there must be sell volume in the market pushing the price downward. This means that someone interested in this movement must open a short position. Upon reaching the zone of interest, two entirely different processes occur with the same identical outcome. The price impulsively moves up. Why does this happen? We already covered part of this logic in the previous video, but I'll quickly recap. When there is a liquidity zone, it means that stop losses of players who previously opened their positions are likely located behind a certain fractal. Thus, this zone is of interest to a large player because there are those ready to buy or sell a lot. They actively exploit this. This logic works the same way here. The price tests the liquidity zone, activating the stop losses of players who previously opened long positions. These are sell orders or sell-side liquidity, but at the same time, the large players' buy orders are activated, allowing them to accumulate a large portion of their position here. Thus, the sell orders acted as counter-liquidity for the buy orders. The reason the price moves up impulsively is that the volume with which the large player operates significantly exceeds the volume of everyone else combined. When the price tests an inefficiency zone, like a fair value gap, it gets the primary buy volume due to unfilled orders, often leading to a reversal in the opposite direction. It's quite possible that these unfilled orders belong to the same large player who wants to fill them, providing an opportunity to accumulate their position at lower prices. This is why I believe that the order block mainly has a manipulative formation mechanism. The same logic works in reverse for a bearish order block. Again, the question arises, why does the price react when testing the order block zone? There are three main reasons why this might happen.